Welcome to Breaking News to Trading Moves. So, have you ever sat down at your trading desk at, say, 9 a.m., feeling like this highly disciplined professional, only to find yourself revenge trading like a casino addict by 2 p.m.?
Oh yeah, countless times, honestly.
Right, it's so common. You walk into a room where numbers are just endlessly ticking on digital displays, bright colors are flashing in your peripheral vision, and, alarms are constantly chiming. The physical environment itself is engineered to extract a reaction from your nervous system.
It really is. It's an architecture of manufactured urgency.
Exactly. It creates an atmosphere that demands participation. We typically associate that specific environmental design with a casino. But for a day trader, that exact same psychological architecture is consolidated right into a 15-inch monitor sitting on their desk.
And, day trading is often sold to people as this ultimate tool of liberation.
Right? No commute, no manager.
Exactly. Complete autonomy. But the supposed tool of liberation frequently mutates into a relentless taskmaster. The very flexibility of day trading devolves into an exhausting dependence on that piece of glass.
And that is exactly the tension we're tackling today. We're looking at the paradox of the trading screen. So I'm taking the position that the sheer mechanics of constant market access actively degrade a trader's objectivity over time.
Okay, I see where you're going.
Yeah, because of this biological and psychological wear, strict structural boundaries like fixed hours and hard daily stopping times are the mandatory defense against the screen.
And I come at it from a different way. The physical screen isn't the primary threat here.
It isn't?
No, the actual hazard is a cognitive misunderstanding of opportunity, strategic clarity, and redefining your relationship with market data. Not just, relying on arbitrary time limits are what truly protect a trader's edge.
Well, let's get into the actual biology of what happens when you stare at a screen for hours, because we have to understand the mechanism behind the fatigue.
Sure, lay it out.
So your prefrontal cortex handles logic, probability, and risk management, but it has a battery life. When you stare at a 5-minute chart for hours, you're forcing that part of the brain into overdrive.
Because of the micro decisions, right?
Yes, exactly. Every candle closing, every flicker of the bid-ask spread requires these tiny micro decisions. Eventually, that battery just drains and decision-making gets handed over to the amygdala, the emotional center of the brain.
Which is where the trouble starts.
Oh, definitely. That's when normal, everyday volatility starts to masquerade as actual opportunity. You get bored or you get fatigued, and your brain simply demands action. You can't rely on willpower alone. You have to implement rigid physical constraints.
Like what, specifically?
If you don't enforce fixed schedules and clear daily loss limits, your schedule becomes controlled entirely by market uncertainty.
Well, I understand why you frame the issue around visual and biological fatigue, but the root problem is the psychological fallacy that every single move matters.
How so?
You are going to miss breakouts. You are going to miss trend days. You are going to miss perfect-looking setups. That is unavoidable in this profession.
Right, you can't catch everything. Exactly. The true trap is mistaking activity for progress. When a trader sits there feeling that a quiet session is wasted time or takes it personally when a move happens without them, they are operating under a cognitive deficit, not just a physical one.
But doesn't the physical setup contribute to that?
Secondary to the mindset, the solution lies in cognitive preparation and strategic selectivity. If you trade only predefined setups, the physical time spent near a monitor becomes secondary. Enforcing a set stopping time treats a symptom, whereas mastering selectivity addresses the core issue.
But doesn't the sheer biological reality of staring at moving targets inevitably override even the best strategic preparation? I mean, the market always offers information. It does not always offer opportunity.
That's a fair distinction. Right? So when you sit in front of a chart for hours, your brain starts searching for reasons to act, regardless of your prep work. You end up entering weak setups simply out of boredom.
Or desperation.
Yeah, you chase moves because you feel left behind. Or, quite commonly, you hold on to poor trades because you have invested so much attention into watching them develop. The sunk cost isn't just financial, it's measured in focus.
See, I think you're conflating consuming information with being consumed by it.
I don't follow.
Yes, staring continuously at moving targets induces fatigue. But I have to ask, why is the trader staring continuously in the first place?
Because they're waiting for their setup.
But if a trader relies on automated alerts rather than manual chart watching, the screen loses its hypnotic power. The exhaustion you're describing only happens when a trader treats all market noise as data that requires an immediate real-time response.
But you still have to watch the execution.
Sure, but the moment you define your setup and let the software notify you when your specific parameters are met, the pressure dissolves. You outsource the monitoring to the machine.
I'm not convinced by that line of reasoning, because the visual stimulus is relentless and the financial stakes are very real. Let's look at the casino analogy again.
Okay, go ahead.
A slot machine doesn't just take your money, it gives you near misses. You get 2 cherries and a lemon. Your brain gets a dopamine spike that is almost identical to an actual win. That is exactly what happens on the trading screen.
The almost setups.
Right. You see a setup forming, it almost meets your criteria, you get ready to execute, then it breaks down. You didn't lose money, but you expended cognitive energy and triggered a dopamine loop.
I see what you mean.
These behaviors don't stem from a lack of alerts. They stem from the illusion of control. The trader believes they are managing risk, but the constant availability of the market erodes their discipline until they break their own rules.
I'm sorry, but I just don't buy that. Let me tell you why. Time boundaries are a blunt instrument for a highly nuanced problem. Let's examine the revenge trade scenario.
A classic problem.
Right. A trader takes a loss, experiences frustration, and immediately re-enters the market to make the money back. If that trader has a rule that says, I stop trading at 2 p.m., and the loss occurs at 10 a.m., that time boundary offers absolutely zero protection.
It might not stop the immediate reaction at 10 a.m.
Let me just finish this thought. The edge comes from patience and risk control. Missing a trade isn't a failure. Taking a poor trade because you are afraid of missing out is the failure. If a trader masters that cognitive reality, revenge trading ceases to be a threat entirely.
I hear that. But what about the slow bleed? What about the trader who takes a minor loss at 10 a.m., stays disciplined for a few hours, but then the screen wears them down by the afternoon?
You mean the fatigue factor again?
Yes. Let's map this onto a real-world scenario that anyone listening to this will recognize. The lunchtime chop.
Ah, yes. The ultimate danger zone for retail traders.
Exactly. The market opens with high volume, you get clear trends, you make your trades, then 11:30 a.m. rolls around, volume dries up, the institutional algorithms take over, and the market just chops sideways in a tight range for 2 hours.
Which is when most people give back their morning profits.
Right. If you don't have a rigid structural rule that says, I step away from the desk between 11:30 and 1:30, what happens?
You sit there. You stare at the 1-minute chart.
And you start imagining things.
You start seeing patterns that don't exist.
You force a trade out of sheer boredom because your brain craves the dopamine hit of being in a position. A strict schedule, a time limit, acts as a physical circuit breaker.
A circuit breaker?
Yeah, when a machine overheats, the circuit breaker cuts the power to save the entire system from melting down. When emotional friction overheats a trader, stepping away cuts the risk to their capital.
Your circuit breaker analogy is flawed because human beings aren't passive electrical grids. We learn, we adapt, or at least we're supposed to.
But biology is biology.
Sure, but if you force yourself to walk away at 11:30 every day just to avoid the lunchtime chop, you're avoiding the symptom. You aren't curing the disease. The disease is the inability to sit with boredom.
Sitting with boredom is incredibly difficult when money is on the line.
It is, but the disease is the false belief that you need to be in a trade to be a trader. Doing nothing is a highly active, intentional state in trading. It's the conscious choice to preserve capital.
I don't think most people see it that way.
They don't, but they should. If a trader requires a clock to tell them to stop being bored, they are treating the market like an entertainment vehicle. The best operators know when to stop watching because the conditions don't suit them, not because their shift is over.
So you're expecting traders to achieve monk-like enlightenment while dealing with live financial risk? I think that's asking too much of human biology.
It's not enlightenment, it's just discipline.
Let's talk about the well-documented 90-minute rule of cognitive decay. Cognitive scientists have shown that the brain operates in basic rest activity cycles.
After about 90 minutes of highly focused attention, your cognitive performance drops off a cliff.
I'm familiar with the concept.
So, if you rely solely on your internal sense of strategic selectivity, you are asking a tired brain to accurately assess its own level of fatigue. That is a well-known cognitive blind spot.
You're saying they don't even realize they're tired.
Exactly. By the time you realize you are too tired to evaluate a setup properly, you are likely already in a bad trade.
But that entire premise assumes the trader is constantly evaluating data throughout the session.
Which most of them are.
Well, if you are constantly processing new information and making complex decisions on the fly, then yes, your mental energy will deplete rapidly. But the purpose of a predefined setup is to front-load the cognitive work.
Front-loaded how?
You decide the parameters before the market even opens. During the actual session, you are merely executing a binary decision. Does the current price action match the predefined parameters? Yes or no? That doesn't require immense cognitive stamina. It requires operational discipline.
It still requires resisting the temptation of the setups that almost match the parameters. We discussed the near-miss dopamine loop earlier.
Right, the cherries on the lemon.
Every time a trader watches a candle close just shy of their entry criteria, then watches the price rocket in their anticipated direction without them, they experience a psychological hit.
It's frustrating, I admit.
A missed move feels deeply personal. The trader starts thinking, I was right about the direction, I just missed the execution. That frustration builds up over hours.
And you think if clock stops that?
A hard stopping time prevents that accumulated frustration from spilling over into a forced trade later in the afternoon.
Look, I agree that the feeling of a missed move is a powerful psychological trigger, but the defense against that isn't walking away at a predetermined hour.
Then what is it?
The defense is accepting the premise that you don't need to capture everything. Your job isn't to watch everything. Your job is to act only when the trade is worth taking.
That's easier said than done.
Of course it is. But if a trader is getting frustrated by a missed move, they are still operating under the illusion that the market is a puzzle they must solve perfectly. Once you accept that day trading is an exercise in probability, a missed move is just a single data point in a series of hundreds of trades. It isn't a personal failure.
I see why you think that, but let me give you a different perspective. When a quiet session feels like wasted time, structural constraints like a maximum number of trades per day or a strict daily loss limit remind you that the session is bound by rules, not by excitement.
I'm not against daily loss limits.
But they demand physical separation from the environment, because the environment itself is coercive. Think about the platforms themselves.
You mean the software?
Yes, brokerages don't design trading software to be calming. They use high-contrast colors, jarring audio alerts, flashing red and green numbers. They gamify the experience. The order book flashes like a strobe light.
They do. They borrow directly from the casino playbook. The UX design is intentionally addictive.
Right. So if you're sitting inside a digital casino and you tell yourself, I'm just going to rely on my operational discipline, you are fighting a multi-billion-dollar behavioral engineering machine with sheer willpower. That is a losing battle.
You're painting the trader as completely helpless.
Not helpless, just human. A fixed schedule says, I will look for my edge for these 3 hours. If it does not appear, I am done. It physically removes you from the casino entirely. It preserves your capital, yes, but more importantly, it preserves your emotional baseline for the next day.
As I said, I don't dispute the value of daily loss limits or maximum trade counts. Those are vital risk management tools. My contention is specifically with the reliance on arbitrary time limits, like forcing a stop at noon regardless of market conditions.
Why is noon arbitrary if your brain is tired?
Because the market's variable nature means an edge might appear outside your rigid schedule. What if your strategy relies on late-day volatility, but your rigid rule says stop at noon?
You adjust the rule for your strategy.
But then you are constantly moving the boundary. You are sacrificing your edge for the sake of structure. Day trading should fit inside your life through the ability to leave the market alone when conditions don't suit the strategy. The true boundary is the setup itself.
But relying on the setup as the only boundary assumes you maintain the perspective required to evaluate it accurately. Let's look at one of the most common pitfalls: Moving stops because of short-term noise.
Which is a terrible habit.
If you're listening to this, you've probably done it. You analyze the daily and hourly charts. You set a logical stop based on a broad structural view of the market. But then, you sit and stare at the flickering 1-minute chart for 2 hours.
The microdata.
Exactly. Suddenly, a minor, totally normal pullback looks like a catastrophe. The constant stream of microdata overwhelms your macro perspective. You interfere with your own strategy and move the stop.
Right, but
The error wasn't that you lacked a predefined setup. The error was that you stared at the screen too long. The duration of observation ruined the quality of observation. Stepping away from the screen entirely is the only way to restore that broad perspective.
or you could restore perspective by simply trusting your predefined parameters. If the stop is set, the decision is made.
People don't work like that.
They have to learn to. The error isn't that you stared at the screen too long. The error is that you allowed new, lower timeframe information to override a higher timeframe decision. That is a failure of logic. You attributed meaning to noise.
But the noise is so loud.
If we teach traders that the screen itself is the enemy, we absolve them of the responsibility to master their own reactions to data. The data is neutral.
Saying the data is neutral is technically true, but human beings don't process data neutrally. We are hardwired for survival, which means we are hardwired to overreact to perceived threats.
Financial threats in this case.
Right. When a trade goes against you by 5 ticks, your brain doesn't see a neutral data point. It sees a threat. It releases cortisol. Your heart rate elevates. You manage financial risk with stop losses. You have to manage psychological risk with time limits and structural boundaries.
I just think that's overly defensive.
The gravity of the screen is real. It pulls attention, demands reactions, and blurs the line between patience and hesitation. Without hard physical limits, the flexibility of day trading becomes a prison built by uncertainty.
And I maintain that the prison is constructed entirely of false beliefs about what the market demands of you.
Which is nothing, right?
Exactly. The market demands nothing. It simply moves. When a trader realizes they don't need to catch every reversal and that missing a setup is not a reflection of their competence, the screen stops being a taskmaster. Cognitive discipline is the ultimate protection. You act only when the trade is worth taking. Everything else is just background noise.
Let me push back on that idea of background noise for a second. If you're trading from home and the market is open, isn't that noise constantly echoing in the back of your mind?
Not if you've developed the right mindset.
I don't know. Even if you've decided there's no trade right now, if you don't physically shut down the platform and walk away, your subconscious is still monitoring the situation. You're still half listening to the financial news, still glancing at the chart on your second monitor. You aren't truly disconnected.
That happens when a trader hasn't fully committed to the concept of selectivity. If you're still glancing at the chart hoping for something to materialize out of thin air, you haven't actually accepted that the conditions aren't right. You're still lingering in the casino, hoping someone drops a chip on the floor.
That's a great way to put it. Lingering in the casino.
Right. But if you have true cognitive discipline, you can leave the casino mentally, even if the monitor is still on. You can read a book, work on a different project, or review your past trades. You don't need an alarm clock to force you out of the room. You just need the maturity to recognize when your edge isn't present.
I see the distinction you're making. When you look at our two approaches side by side, my position remains that the psychological gravity of the trading screen acts as a mechanical force. It wears down objectivity over time, burning through your cognitive battery.
The biological constraint.
Yes. That's why I believe rigid structural and temporal rules like fixed schedules and hard stops are required to protect a trader's capital and their mental energy.
And my position stands that the true protection comes from cognitive discipline. The hazard is the belief that every tick of the chart matters.
The false necessity to act.
By accepting that you don't need to capture everything and acting only when a trade strictly meets your predefined criteria, you build a defense that is far more robust than constantly watching the clock.
Yet, despite our different angles on the solution, we clearly converge on the underlying reality of the market. The market will still be there tomorrow. There is no single trade that must be taken today. A trader's job isn't to observe and react to everything the market does.
Precisely. The goal is to execute an edge with precision, whether you protect that edge through structural circuit breakers or through rigorous cognitive selectivity. The endgame is the exact same, preventing the endless stream of data from dictating your actions.
Examining both the structural and cognitive defenses against overtrading reveals just how complex this environment really is. There is so much more to explore within the mechanics of trading psychology, and this discussion provides a robust framework for that exploration.
It really does.
It leaves us to evaluate our own routines, our own boundaries, and our own reactions to uncertainty. We started by comparing the trading monitor to the architecture of a casino designed to manufacture urgency and demand participation. The ultimate question is whether you walk out of that room by setting a strict time limit or by realizing the flashing lights never actually required your attention in the first place.